The first Fed meeting of the year officially in the books, along with the first news conference, of course, of Chair Jay Powell. The question on everyone's mind going in, when will the first rate cut come? Clearly, the chair was non-committal on that. He did say in his comments a few moments ago that it will likely be appropriate to begin reducing rates sometime this year, that the hiking cycle most likely done. The money line of the whole day seems to be that question he got about a March cut in which Chair Powell said, quote, probably not the most likely case. Well, stocks didn't like that at all. They sold off pretty quickly. That's pretty much where they sit now. You can see we've got 1% plus declines for the S&P, the NASDAQ, and the Russell. Dow has gone negative by about 2/3 of 1%. Think the bottom line, cuts in play. Who knows when? Who knows how many? That's probably just the way Chair Powell wants it to. So on that note, let's bring in Jeffrey Gundlach. He is the CEO, CIO, and co-founder of DoubleLine Capital. Joins us for our first Fed meeting of the year. Jeffrey, welcome back. What's your assessment of what you just heard?
Well, you're right that the money line was we're not cutting in March as a base case. And I think that that's going to be the case because we have an inflation model. I've talked about this after every Fed meeting. And we knew that inflation was going to come down. But for now, we think there's going to be a stall in the inflation rate coming down. And that will probably mean that the market isn't going to get the Goldilocks picture that it was euphoric about a couple of weeks ago. And that is that the Fed's cutting, it's going to come soon, it's going to be quickly. That's not going to happen. So I think risk assets got to a very high level of enthusiasm, not just stocks, but things like junk bonds, bank loans, very, very high prices relative to where we've been on average over the past couple, 3 years. In fact, a lot of these markets are kind of back to where we were at the beginning part of 2022. And so I think that Jay Powell did a really good job of being candid, I would say. There was a lot of less hand-waving, I guess, and more statements. And the one on March was obviously the big one that tanked the stock market and got the bond market a little bit less enthusiastic, although the short end is still down significantly in yield. So on we go to the next meeting, and we'll see what happens. But the baseline here is the market can't expect a rate cut in the next 2 or 3 months.
Does March really matter when it comes down to it, as long as even the Fed chair admits they're likely to cut at some point this year? It's the trend that matters more than the date. Isn't that correct?
That is correct. But the market really, not very long ago, was pricing in March pretty heavily. And that led to very high valuations on a lot of risk markets. And the longer that the Fed stays at what is going to be about a 200 or 300 basis point real interest rate on Fed funds, there's risk to economic growth that's going to build as we move into this year. You know, everybody knows that the employment market on the headline establishment survey looks really good, but there were a lot of downward revisions in the last employment report, and the household survey isn't as strong. And there's also data that never gets reported to the extent it should be, which is unemployment data that's reported on a state level. The states do this too. And they have 51 states. I think they have D.C. in there as if it's its own state. And something like 85% or more of those 51 state reports have rising unemployment over the last 6 months. So there's a strange mathematical inconsistency that the unemployment rate stays at 3.7 on the national establishment survey, but over 85% of states report that unemployment is rising over the past 6 months. It almost doesn't seem possible. Now, the states that are not reporting rising unemployment are Wyoming, North Dakota, yes, Texas, I think Pennsylvania, but not California, not Illinois, not Florida, not New York. So I don't know. Is unemployment really as low as we think? With continuing claims are rising, that's a leading indicator. Temporary employment is falling, that's a leading indicator. And the quits rate is now in every sector about the same as it was pre-pandemic. So this narrative of there's nobody quitting is just false. It's all the way back to where we were pre-pandemic.